Hello, listeners and friends and colleagues and subscribers and anyone else getting this on the internet. Welcome back to another reading of Readings in Impact Investing. This is a new podcast created by myself, Daniel Rosehill, intended to take good material in the world of impact investing and development finance and make it available through the medium of audio, and so that you can get it when you're at the gym or commuting or whatever. And my voice is clearly going to be better than a voice-to-speech robot. I'm just kidding. I mean, I hope I'm not kidding, actually, because I think it's probably better. Those robots are getting good, but I like to interject with my own comments from time to time. So for the moment, this is a human-narrated podcast. Perhaps in a few years, that will seem very, very quaint. A human still speaking into a microphone. This podcast is available online at readingsiниmpact.org. And from there, this goes out to your various pod-catching places, such as Spotify, Apple Podcasts, etc. Just because there's been a couple of feeds going out there, I moved on to a new host like a week ago. Just make sure that you're getting an accurate and a recent feed. There should be something like 30 episodes at this point. I will probably slow down a little bit on the rather frenetic pace of episode creation. I'm just kind of getting this going, and I'm actually having a really good time with it, catching up on a lot of reading material as I make these episodes. So today I'm going to be reading a blog post from Marcus Pratsch. This appeared on omfif.org, which is... I think I've reached my limit of acronyms that I can read out today. OMFIF is an independent think tank for central banking, economic policy, and public investment. And their website is omfif.org. And Marcus Pratsch is the head of sustainable bonds and finance at DZ Bank AG. This article is part of the Sustainable Policy Institute's August 2023 journal launching November 27th. This was written on November 9th, 2023. So, with that introduction out of the way, let me read this article from Marcus. Innovative financing instruments are not only distinct, they are necessary to ensure sustainable development. Developing countries are highly vulnerable to climate change. To add, emerging markets are on average further away from meeting the UN Sustainable Development Goals than developed nations. Significant capital is therefore needed to close the sustainable funding gap in these countries. According to the UN Conference on Trade and Development, in developing countries alone, SDG investment needs to amount to $4.5 trillion for basic infrastructure, food security, climate change mitigation and adaptation, health and education. To mobilize private capital for sustainable development, capital markets are a critical source of long-term funding. In the past, emerging markets have lagged developed markets in terms of sustainable finance, but luckily their relative share of financial flows has increased in recent years. To ensure that this positive trend continues, we need innovative financing instruments for sustainable development. The global fixed income market, with a volume of more than $100 trillion, is one important source of innovation to support the transition to a more sustainable future. Hence, we must investigate the sovereign sustainable bond segment, in which sustainability-linked bonds have successfully found their place since last year, along the traditional use of proceeds variants, such as green, social, and sustainability bonds. So I'm just going to interject here, and I'll mention when I go back to the article. We saw recently this category is often called GSS, Green, Social, and Sustainability Bonds, and they're often described as use of proceeds. So use of proceeds mean that these bond labels are divided according to what the bond is raised for. Usually when a bond is raised, whether it's by a corporation or by a sovereign, it's just kind of an amount of money that's being raised, and it's not necessarily stated that this is for such an earmarked expenditure. However, for these use of proceeds bonds, the bonds are raised explicitly for something sustainable. And the divisions between these different labels, green, social, and sustainable, get a little bit blurry. And I think a lot of it's often up to the issuing institution to say, hey, we're going to call it one of these terms. Just want to point out, I've also seen SDG bond being used as a label recently, or I've heard about that from folks. And in other words, there's an SDG bond. I think that label is intended to track one of the SDGs, like the bond is raised for this goal, which is very aligned with X SDG. So back to Marcus's article. But first, it's important to clarify what target-linked financing, which is still relatively new, entails. SLBs, which first emerged in 2019, are forward-looking and performance-oriented financial instruments in which issuers explicitly commit to future improvements in sustainability criteria within the predefined timeframe. Understanding SLBs. Sustainability development is measured using predefined key performance indicators and evaluated against sustainability performance targets. The financing costs of SLBs are linked to the achievement of these targets. If the issuer fails to meet the targets, financing becomes more expensive. Let me jump in again. So commonly this is referred to as a step-up or step-down coupon. And it pointed out that SLBs emerged in 2019. I want to point out that they emerged as a corp. For the first SLB was issued by NL. So initially, this was a type of debt instrument involved in corporate issuance. But later we've seen sovereign SLBs issued. The financing costs of SLBs are linked to the achievement of these targets. If the issuer fails to meet the targets, financing becomes more expensive. As the use of proceeds of SLBs are not earmarked and can therefore also be used for general financing, they are also suitable for issuers who do not have the necessary volume for a use of proceeds bond. Governments, for example, can use the instrument as a source of funds for general budget spending like any other government debt. It can also use the instrument to mitigate balance sheet risks by reducing maturity or currency mismatches, but with a link of a refinancing mechanism if nationally determined contributions or other targets are met. For credible, sustainable financing using SLBs, it is important to choose KPIs that are relevant, measurable, and comparable. These factors are central to the issuer's sustainability goals. They should also have a high strategic importance for the issuer's future. In addition, the SBTs should be in line with the issuer's sustainability strategy and be ambitious, i.e. go beyond a business-as-usual scenario. So the idea with that Marcus, and this is me commenting here again, the idea that Marcus is pointing to is that, these SLBs are intended that the issuing entity should have to improve its sustainability performance by achieving these KPIs. Sometimes they're called SBTs. I think there's a bit of kind of blurriness there as to which terminology is used. It's still kind of in flux as to what's being adopted. But they shouldn't just say, we are doing, this is our current, we're currently recycling, X, and we're going to raise this SLB to continue recycling X, right? That's the business as usual. They're intended to create an incentive, really, I guess. It's an incentive and creating mechanism for the borrowing entity to actually improve their performance, and they'll be rewarded for that through cheaper financing. Are SLBs here to stay? This is back to the article. By the end of the third quarter in 2023, 49 sovereigns have issued sustainable bonds with a cumulative volume of more than $400 billion, with the use of proceeds structure clearly dominating. So far, 32 countries have issued green bonds, 3 countries have issued social bonds, and 61 countries have issued sustainability bonds. While SLBs have become popular among corporate issuers, they are far less established among sovereign borrowers. Although SLBs are a suitable instrument for linking sustainable sovereign financing to, for example, NDCs, only Chile and Uruguay have so far adopted the target-linked funding variant. Scaling up SLB issuance in developing countries would offer more and more issuers access to new sources of finance. By issuing the world's first sovereign SLB in March of 2022, Chile successfully demonstrated that sustainable bonds could monetize not just sustainable public expenditure and infrastructure, but also be instrumental in monetizing sustainable policies and national commitments. These include the NDC set by the country under the Paris Agreement on climate change. In October of 2022, Uruguay also linked the coupon of its SLB to compliance with the climate and environmental goals that the country set in its first NDCs to the Paris Agreement. In addition, it also featured a nature-based KPI. Major potential in sovereign sustainable bond market. Following the success of Chile and Uruguay, it is likely that SLBs will attract issuers from beyond Latin America and that we will see issuance from Southeast Asia or Africa, for example. SLBs are expected to become increasingly popular among sovereign issuers from emerging markets as the flexibility in how the borrower uses money raised makes this type of debt attractive to smaller issuers that may not have an extensive pipeline of green or social projects that would qualify for green or social bond proceeds. So let me just jump in again with a comment here. That's very important, and I think this is why I thought this was a good article to read. SLBs are not use of proceeds generally. I think that one could devise a prospectus for a new SLB that was use of proceeds, like as in saying we're going to raise an SLB and it will be use of proceeds, but generally they're not. So that means that a sovereign that may not be able to earmark their budget, know exactly we need this many $1 billion for exactly this, which can be bucketed under a sustainability bond, may instead choose to issue an SLB that will still force them to be more sustainable, but they won't have to earmark the budgets that in a way that would that is required for them to qualify for use of proceeds bond labels, if that makes any sense. Looking at the numbers, the sovereign, and this is back to the article, looking at the numbers, the sovereign sustainable bond market offers enormous potential here. About 170 countries are issuing sovereign debt. Hence, there are plenty which have not come to the market yet. This includes 3 sovereign issuers with the largest outstanding volume, which are the US, Japan, and China, as well as many issuers from developing countries. So that brings to a conclusion that article. I think that was very helpful in outlining the potential for sovereign SLBs, especially in emerging markets and emerging markets also being, of course, places where climate change needs to be addressed as most critically. I hope that this has been useful. Thank you for listening to this quicker episode than usual of Readings in Impact Investing. If you'd like to get in touch for any reason to suggest a reading or just to say hello, feel free to do so. It's public at Daniel Rosehill, ROSEHILL.com. Thanks for listening. Wishing you a great day.